Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
With us around the table, Citi's Veronica Clark, Invesco's Rob Waldner. I am not going to bury the lead, Veronica. We're going straight to your call. July rate cut.
July rate cut.
I need to know how bad the number needs to be tomorrow to keep that in play.
Yeah, honestly, I think the bar for bad labor market data for the Fed to be cutting sooner than the market is pricing is pretty low. Tomorrow, we think we're going to see 140,000 payrolls, which is a further slowing, obviously, from the slowing we had in April. The level of job growth, that's still a pretty healthy level, but it's the trend that's concerning. I think the unemployment rate can go to 4.0% tomorrow. That's the Fed's end-of-year forecast, and we're hitting that sooner than they expected.
The favourite phrase of every constructive economist on Wall Street right now, rebalancing, normalisation. You don't share it. You don't share it.
No, I think the issue is when you're going from a region where you're running too strong and you're moving to a region where you're running too weak, you will have a moment where you look like you're in balance. It's the trend that's concerning, and I don't see any good reason why this cycle wouldn't follow previous cycles where you do get that slow weakening and you suddenly get an accelerated weakening.
So now for the cage fight, Rob Waldner, who has completely the opposite view. He doesn't think July is anywhere in the cards. He thinks September probably. I mean, how much do you disagree with that approach?
I think that the big thing I disagree with is we think the growth will continue at a more steady pace than I think, Veronica, you laid out, which is, we have an economy with a lot of momentum to it. And so the growth on its own doesn't really justify a rate cut. And so the rate cut narrative of multiple rate cuts, I think, is built on a growth narrative. What justifies a rate cut in September is kind of the way the Bank of Canada laid it out yesterday, which is, hey, the economy might be growing, but inflation is coming down. We're in continued disinflation, and we just don't need as much restriction as we used to have. So that's a different kind of narrative, and I think one where the Fed will be a little bit more cautious and will continue to be data dependent, which means, they do one in September, and then they watch to see how things come in. We think probably September and December, maybe 2 cuts.
So pause. The difference between you both is not just a few months. You've got a completely different way of looking at this economy. How many cuts are you looking for in the next 12 months?
200 basis points total.
200 basis points total.
Yeah, until mid-2025, yeah.
Okay, you're nowhere near that, are you?
No, we're not on a base case. We're not looking for 200 basis points.
Okay, so you can drive a truck through the two opinions around this table right now.
Well, which is the reason
there's
why...
no rate hikes at the table.
Hold on a second. Okay, well, there you go. But Rob, to that point, just to sort of elaborate the aspect that you disagree with, that we're hearing from Veronica, this is going to be more like a normal cycle, where once they embark seeing that weakness, it's going to accelerate. What in the data gives you confidence that's not the case?
Well, I think what in the data would point the other way, we don't see that in the data that would point to this weakness. I think there's a lot of concentration on this increase in the unemployment rate, which you talked about, and looking at, past cycles, the SOM rule, other things like this, which have pointed to, recessions following an increase in unemployment. What we see in the labor market is that the stress has been removed from the labor market, right? That's what job openings and hires and quits are telling us. But still a healthy labor market. Look at the jobless claims number today. So we don't see, a big growing weakness there.
Veronica, I'm sure that you guys get a lot of pushback.
Yeah, no, absolutely. But yeah, I would certainly disagree on the signs of weakness. I think in the labor market, what we've seen is, hiring rates that are at 10-year lows, part-time employment increasing, hours worked coming down. It feels like all the early signs of businesses looking to cut labor costs. And we heard that in the anecdotes of the ISM report yesterday. What we don't see yet are the layoffs, but that would really be the last step. And we have had a worsening of, consumer sentiment around job prospects around the labor market in the last couple months, and we've seen that reflected in a pullback in spending. We've had real goods spending declining 3 of 4 months of this year, restaurant spending declining. It can be that pullback in spending and activity that gets businesses finally to do that last step of cutting labor costs, which is layoffs.
Can we talk a little bit about communication? How do you think this sort of plays out on Wednesday?
Yeah, it's going to be tricky because we have 2 pretty important reports before then, obviously tomorrow, and then we're going to get CPI inflation in the morning. morning of the meeting. I do think the report tomorrow, if it is showing like what we expect, slowing in job growth, rise in the unemployment rate, this is a Fed that is going to leave all options on the table. We probably do see the dots come up 25 basis points, showing just 50 basis points of cuts for this year. But I think it's really important for us to base our Fed outlook on where we think the data are going and not Fed speak, which could sound stale in a couple months.
It also depends, Rob, on what the market kind of gives them, in the sense that we've already seen suddenly more rate cuts baked in. How do they respond to this idea that this is a market suddenly more biased to seeing weakness and continuing with the Goldilocks trend? Does that make their job easier to really signal that they're going to continue on the same path?
Well, there's been a real challenge for the Fed and for the market, which is the narrative has changed so much, and what's in pricing has changed so much over the last year. If you just look at the volatility of expected rate cuts in 2024, it's been huge because it's responded to higher for longer, then slower, multiple cuts at the beginning of this year. And they've been very steady through the whole thing. You haven't seen them react to that. They've been, we think we have a chance at a soft landing. We think we're in disinflation. They've been very, very steady. And so I don't think they're going to respond to this change in market narrative. I think we're going to get Powell talking about disinflation continuing. There's a lot of tension around the exact inflation numbers and what they're telling us. I think we'll probably see quite a bit of conversation around that. And, I don't know, I would be surprised if there's a lot of discussion around the labor market, but maybe there will be.
Let's have a conversation about the bond market. We've had a big move. 5 days, 30 basis points lower on a 10-year plus, more than 20 basis points lower at the front end on a 2-year yield. Lisa and I were talking about this a little bit earlier. We've had tons of conversations about how risks are skewed asymmetrically to lower yields going into data points because the Fed won't respond to strength. Given the move we've had over the last week or so, just what is the setup going into payrolls, going into CPI next week?
Well, because the curve is inverted, right, we have negative carry the further you go out in the curve. And so I think that limits the ability to rally too much from here. I mean, so if you get down closer to 4%, I think we would be going underweight, and I think that both the rates market really is a range trade here. It has been for quite a long time, and we're getting towards the bottom of that range.
You don't think we're more sensitive to weak data, but more sensitive to strong data tomorrow? Is that fair?
I think that's fair, yeah.
OK, all right, let's think about it. Maybe it was the way I phrased it. Rob Waldner of Invesco, thanks, sir. Appreciate it. Veronica Clark of Citi with quite a call for July. Ed Mills is with us around the table. Ed, good morning to you.
Good morning, John.
Let's start there with foreign policy. Where does that rank just in terms of voter concerns this year?
I think it's probably one of the biggest drags on Joe Biden's reelection. If you go back and you look at right track, wrong track of the country, favorable, unfavorable ratings, when you go to see where it shifted from Biden having a net favorable rating to a net unfavorable rating, it was back in the awful withdrawal from Afghanistan in August of 2021. He's not recovered since. And when you look at Trump voters, one of the things that they're saying is that there wasn't the same level of geopolitical issues under Trump. And so, fear or not, that's driving support for Trump, and it is pulling down the polling numbers for Biden, especially among key parts of Biden's base, younger voters.
Do you think it's execution or ideology? Because what we see from Biden, he's proud of it. He talks about alliances, allies, multilateralism. What you hear from the former president is a form of isolationism, and that's going right the way through some parts of Congress as well. Which one is it?
I think it's both. I mean, America First, which is Trump's saying, is something that's really popular with his base. It's part of populism politics. That is a core part of kind of the ability to appeal to a broader swath of voters than Republicans have traditionally done. There's a big bifurcation. You look at the Senate, which is his, more senior, kind of been in D.C. longer, fully supportive of Ukraine and was overwhelming in their support for their last aid package. It was the House of Representatives, the newer members to D.C., that are more aligned with President Trump, more aligned with the MAGA movement. And those were the ones that really did not want to see kind of the funding that went to Ukraine, and that got passed a couple months ago.
Tomorrow, President Biden's going to be in France. He's going to be there for ahead of the G7. And he's going to deliver a speech on the anniversary of D-Day. I'm curious about this speech on democracy and freedom. It'll be music to the ears of a lot of the European leaders there. How will it be received, do you think, in the United States?
So I think it's important to remind the world of America's power. I think it's important to remind the world of the accomplishment that occurred 80 years ago. I'm also looking at the fact that we are going to commemorate and celebrate the 75th anniversary of the NATO alliance. And so in an American audience, I still think that American leadership is important, but there's also kind of it's the economy, it's the inflation, it's the day-to-day harder kind of existence as voters that look at this more as a nice to have than a necessary because we have not had that same level of threat that we felt in the immediate aftermath of World War II. One of the questions I get a lot at Raymond James is, we're celebrating the 75th anniversary of NATO. Are we going to celebrate an 80th, especially if there is a second Trump presidency? What I tell them is that something that was under the radar in the defense authorization bill last year was Congress tried to future-proof this. Congress is concerned about the NATO alliance and strip the president of the power of unilaterally withdrawing from NATO. So Congress cares about this, probably more so than the average voter.
But there isn't going to necessarily be a galvanizing kind of impetus from the idea of talking about democracy and freedom. And this is, I think, a big divergence from the last Trump-Biden mix-up, where basically you had the threat of losing democracy as somehow galvanizing voters to get to the voter booth. Is it going to have the same appeal this time around? So
I think there's probably going to depend on how much the Biden campaign tries to execute on this strategy. And I'd also say how much Trump talks about it. To the extent that he is tweeting out in raising kind of reawareness with January 6th, that was something that helped out Democrats in the lead up to the midterm elections. The Biden focus on democracy didn't rank high with voters, but on the margin, and this election is going to be decided very, very small margins. Biden is going to try to shift the attention to Trump, shift that attention to what we were talking about as it relates to the temperament during crisis, leadership of the United States, and saying, for the next 4 years, who do you trust more? You might not really have liked the geopolitical risks that have existed over the last several years, but going into the future, the next crisis we hit, who do you want in the Oval Office? Biden is going to make the case that it should be him.
Could we just tease out your thoughts on NATO just a little bit more? We've had the Dutch Prime Minister on this programme with us, Mark Rutte, and Rutte's made the point that the former president was right. And I'd love your perspective on this. Do you think he undermined the alliance or reinforced it?
John, it's a great question because what Donald Trump's number one issue with the alliance was the members of the alliance not paying their fair share. And over the course of the last, 6+ years, you've seen a dramatic increase in the kind of other members besides the United States increasing their dollar amounts. And so one of the questions going forward is how much does a threat to the alliance really come down to a transactional discussion? And if you get up to that 2%, and maybe look at kind of the 2% that was not spent over the last several decades, that shifting that dollar burden, and it goes back to that conversation of a lot of Americans support NATO. A lot of Americans want to be the world superpower. I just don't think they want to be the only ones paying for it.
Ed, well said. It's good to see you, as always. Ed Mills there of Raymond James. Let's get to Vasileios Gkionakis of Avivia Investors, who joins us now. Vasileios, how can we have a statement that shows a rate cut and at the same time inflation above target well into next year? Make sense of it for us all.
It doesn't, actually. So I think what's happening here is that the ECB went into the previous meeting having a very, very high degree of confidence, overconfidence that the data is going to cooperate. It made all that noise about the importance of negotiated wages for Q1 that they became available in May. In the end, pretty much all the data have surprised on the upside. You saw in the updated projections, which I thought there were actually more hawkish than I expected them. We went for this year's growth rate from 0.6% to 0.9%, and inflation from 2.3 to 0.5%. And all that within the context of data dependence and conditional guidance. And yet we had an interest rate cut being delivered today. I think that was almost exclusively driven by the fact that it would have been far too embarrassing for the Governing Council to backpedal on its previous pre-commitment. But I think going forward, I hope, in terms of credibility, that the ECB is going to maintain a very, very neutral stance. And definitely going forward, I think the bar for gaining more confidence has increased.
Which is interesting, especially at a time where you do see inflation expectations over the next 5 to 10 years in Germany start to tick up just a bit on the heels of this report. I am curious what you make of this. Ian Shepherdson talking now before this release. He expects the Fed to end up cutting rates more than the ECB. That is counterintuitive against what a lot of people thought at the beginning of this year. Are you on that page now?
I think, given where the data stand right now, it doesn't seem likely. That's not our house view. Equally, at the same time, we have to point out that where the Fed stands right now, it's 150 basis points higher. 175 basis points higher now compared to the Fed. It would take a significant deceleration for the U.S. economy and significant resilience, ongoing resilience. Look, I think I've been on the camp that the Eurozone growth is going to surprise on the upside. But nonetheless, in order for such a scenario which foresees ECB cutting by less compared to the Fed, you would need to see a significant, two things happening basically. You would need to see further fiscal expansion in the Eurozone, which I don't think is likely, and you would need to see Chinese growth surprisingly materially on the upside, which again, I don't think is likely. So I wouldn't say that we're actually in this camp, that personally I'm in this camp actually.
Vasileios, appreciate your input, sir. Vasileios Gkionakis there of Avivia Investors responding to that ECB rate cut.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.